How can you figure out what your real cash flow per door is going to be? And what's the impact of financing as we are in this really wacky real estate market that we're in right now? Hi, I'm Cynthia Meyer with Real Life Planning.
Hi, I'm Veronica Woods with Danny Woods Real Estate.
And this is episode 12 of the Rental Property Cafe. Today, we'll be talking about cash flow per door and the impact of financing, and also the impact of the other things that are happening in this market, low inventory, for example, that are all impacting how we calculate cash flow per door. And Veronica and I have been having this conversation behind the scenes in relationship to what we're seeing with our clients today. Tell me a little bit more, or explain for our listeners, Veronica, what are some of the things that we've been talking about?
One thing we've been talking about is everybody is thinking it's tougher to get the cash flow number per door maybe they were
Mhm.
looking at 5 years ago. And they're wondering, it doesn't still make sense to move forward with the investment if that number is smaller than they were hoping their spreadsheet would show.
We can get anchored to a previous price. We all remember what it was like to have a 2.75 or a 3% mortgage, or even a 3.25% mortgage for an investment property. It's easy to get stuck on that.
I tell people, like, it's not 2018. So that was what happened in 2018.
Mhm.
This is the environment now. I think it's really important. I know we're going to get into some details of really evaluating the investment for where we
Mhm.
are now. The best you can do is figure out the numbers the way they are now.
The real estate mindfulness. So this is number 2 in the series that we wanted to create about running your numbers. In the last episode 11, we talked about the 1% rule and does that still work and when it might be valuable in the real estate process. I think we want to talk today about how much does this really matter? The whole trade-off between appreciation and cash flow. And you and I, we have our weekly conversations. We're always discussing this, right? We're noodling on it all the time. I like to say that cash flow is the cake and appreciation is the frosting. You don't just eat frosting, but we don't always agree on that.
I'm a finance person by nature. I do think that it can't start and end with cash flow. There
Okay.
are other benefits to real estate
Mhm.
thing.
How much does this really matter? The whole trade-off between appreciation and cash flow.
Let's say you have two potential investments. One has more cash flow, but one has more growth potential. Meaning you're
Mhm.
seeing appreciation 10% a year. You're seeing economic development. I'm not going to tell someone to just pick the one with the higher cash flow. Although some people, just being a strict interpretation of cash flow is king, they'll just go after the one with the highest cash flow. But if you're looking over the long-term investment horizon, that may not be the best solution.
We have to connect it back to our goals. Ideally, there's a balance between appreciation and cash flow that you have a little bit of both. It's not one or the other. But depending on the market that somebody is looking in, connecting it back to, do they need to live off this money or are they trying to grow and scale a portfolio? Are they looking to do a BRRRR strategy, buy, rehab, rent, refinance, repeat, where they're looking to build equity and then take equity out of the property for the next deal? I guess the most important thing, and tell me if you agree with this or not, we can't be cash flow negative. You at least have to be cash flow neutral, even if you're an appreciation investor. Real estate has carrying costs, and you don't want to have money out the door against your savings every month to carry a property. That's my point of view, anyway.
I agree with that, but I think it's hard to make that decision in isolation without kind of understanding where you are with your
Mhm.
financial portfolio without getting too speculative. That's the risk of when people are betting purely on appreciation. It's less fundamental, it's more just kind of like going to Atlantic City gambling. I don't think that's real estate investing.
No. Sometimes people look in the review mirror, especially if they're in markets like the San Francisco Bay Area or Austin, Texas, for example, where the value of just regular old homes are just skyrocketing. It seems like the combination of demand from new household formations and demand from people who are looking to relocate from different states and the demand from investors with cash, took profits from other deals in a 1031 exchange and are looking to make a strong offer. There's a lot of demand for properties, which has been pushing up prices in general. It makes it harder to find that good cash flow positive deal, but it's still there. I see people doing it every day.
Right. Do you think it is shrinking a little bit with the go-to metrics?
Although I have a preference for cash flow in my personal real estate investing, and I encourage clients to make sure they're not going to lose money every month on a rental property. If you overemphasize cash flow, it could steer an investor towards a C or a D property that might not be consistent with their overall goals and objectives in the long run. Cash flow could be good, but could be higher maintenance costs or higher vacancy rates or something in that nature.
Just thinking about the property that looks on good on paper, higher cash flow, that might be a harder cash flow to achieve on a monthly basis. One point I wanted to bring up is that the number on the spreadsheet is a plan. It has a lot of assumptions. But real life, you want a good team to manage the execution of that plan. There's a lot of variables from a month to month basis. It's not like a straight line where the cash flow is the same each month. You never know when you have to replace all the flooring in the unit prematurely or a hot water heater goes out. Some of these things are really especially true of older homes. I would say even some newer homes or newer rehabbed homes is also the strength of the team that did the repairs, whether how predictable your operating expense budget is going to actually be.
That makes a lot of sense. And over the years, I've seen people really underestimate costs in a spending plan or budget for their rental property is in the ongoing maintenance and capital expenditures category. People think, oh, it's just been rehabbed. My maintenance will be like $500 a year. And they forget to use typical ratios to develop cash reserves for that property. It's really unpredictable when something is going to happen, and making sure you're reserving for your insurance deductibles and you're putting some money away every month in cash reserves for the inevitable things you know are going to happen. You don't know exactly what they're going to be. Some set of expenses are going to occur to maintain the property, just like maintaining your own residence. And you have to set aside some money for it, or it can send you into a financial tailspin. I have a client who recently bought some older multifamilies in a small town in Pennsylvania. In the first year, even though that client had the properties inspected with a good inspector, stuff just wore out. Things happened all at the same time. A new water heater, a tenant that didn't pay rent in a unit and didn't ask for rental assistance, other maintenance issues, and that kind of confluence of circumstances that happened all in the first year really spooked them a little. The thinking was, is this going to happen every year? And no, probably it's not going to happen every year. It could all happen at once sometimes.
I was just going to ask, when you don't have those cash reserves and
Mhm.
aren't able to take care of a repair and you delay it, what could have been a $500 repair and did impact
Yeah.
cash flow that month could turn into a $1,500 repair 6 months later.
Mhm.
It's really important to manage your overall budget if you want to maximize your cash flow. How good are you at planning for expenses? Sometimes it may make sense to do rehab in phases, like say a duplex. You get one unit up and running, start collecting rent, and that helps fund doing the repairs in the second unit. There's
Mhm.
things that you can do to manage cash flow, which is again why I think just a black and white cash flow positive or not, or even just looking at
Mhm.
cash and cash return in the first year, sometimes is deceiving because there's things that you can do as far as just better managing expenses over time.
Mhm. Keeping abundant liquidity as a real estate investor is risk management. Making sure that either through cash reserves or through access to an equity line of credit, that you have the capacity to meet needs for those kinds of expenses. That is one of the biggest risks in real estate investing. You have this large illiquid investment. You can't easily convert it to cash or monetize it. Even to get a loan against a property, a new loan against property is a very time consuming process. There's no guarantee it's going to happen. Thinking through when you first get started about how can I make sure I can continue to be financially nimble with my cash flow. You never want to get overstretched. cash wise, because that could really spill into your personal finances, cause you to liquidate something that you don't want to liquidate, or cause the whole thing to come tumbling down. What about how things are changing with rising rates? Yesterday, as we record this, the Fed has just announced they're going to raise rates again another 50 basis points, or 0.5%. There could be more of those coming over the course of the next year in order to combat rising inflation. How have you been dealing this with your personal portfolio and with clients too?
The numbers have to work on this
Yeah.
new interest rate environment. And if you go back and look at this a year ago, people were running the numbers at maybe a 3% rate. You're going to have to show a
Mhm.
visual of what the monthly payments look like at 3% versus 5% versus what we could be pushing 7%. And you just really have to run the numbers based on the current rate.
Let's look at that because we put an example together of a comparison of the typical purchase would look like at different rates. Now, for those of you who are in the New York City area, like I am, these numbers are going to look a little low because you can't really buy anything for $250,000 in the New York City area. But for many parts of the country, this can hold. And it sounds like this is a good example of something that might happen in the Philadelphia area.
We were thinking in terms of a duplex,
Mhm.
250,000 and what the varying payment would be at different levels of interest rates.
For the investor who was buying a $250,000 sample property with 25% down, if they'd bought it last summer, their monthly payment on a 30-year loan would be a little less than $800, $791. And with homeowners insurance and taxes, that total cash is subtracted from the rent and expenses would be $1,041. And at current rates, 5.5%, that same monthly mortgage payment will be $1,065 in total out of pocket at 1315. 6 months or a year from now, if rates continue to go up at 6.5%, for example, the mortgage payment has gone up to 1185 from 791 at 3%, and a total monthly payment in that same scenario at 1435. This is just an example. We'll put this in the show notes so that you can see where we got these calculations. But if you're tight on cash flow, if somebody was running the numbers last summer and they were cash flowing a couple $100 per door, that might look great, might not look great at a 6.5% mortgage rate. You have to run those individual numbers and make sure that it still makes sense. Now, the other thing I will say, even at 6.5%, historically, that is not the highest they've been. If we look at where mortgage rates have been since 1990, at the beginning of the dot-com boom, you can see rates were already starting at about 6.5%, went up almost to 9% in the early 2000s, and then have been falling steadily ever since. In terms of the economic cycle, we could see rates continue to rise for a while until the next recession, and then they will probably fall again. And then later on in our lifetime, rise again. Changing rates are a fact of business as being a real estate investor. When you took your first mortgage, do you remember what the rate was?
No, I don't. I first bought a property in 2000.
Mhm.
I don't even remember what that rate was, but clearly by the chart, it was much higher than we're paying right now. I would say that one point I wanted to make about my client is the BRRRR strategy in this environment is a
Mhm.
little trickier in terms of if a rehab takes longer than you planned and rates move, you're stuck if you need to still the money that you planned out. You may have to adjust, you may have to leave more in just because the rate change. That's something for the BRRRR investors, even if you're doing like rent and repeat, that has been tough. I was impacted by that. I could tell you by that a delay of 2 months in finding a tenant, and that impacted what rate we got on the way out. It's something that I've experienced personally. All we could do was, hey, this still makes sense. There's still cash flow positive.
Mhm.
We should take the money out there, the plan to reinvest and buy something else. It is a little unnerving. I understand that a lot of my clients are nervous about the rate changes.
Sure. And it can really affect the bottom line and may make someone change their strategy. It could be that someone was originally thinking they would refinance and use that money for the down payment on the next property. And now maybe they won't. Maybe they'll rent it and they'll look for other ways to improve or raise the rent return over time. For those folks who haven't been through a big recession yet as a real estate investor, I don't think we're in a recession right now. The economy is still good. It's great to be a rental property owner. We're in a rising rent environment. We're in a rising property value environment. I mean, it's a wonderful time to be an investor right now. I've been around for a while and things go up and things go down. And thinking about what works in a specific market environment is what makes the most sense. You have to adapt your model to changing rates. And chances are, of course, we don't know for sure. We don't have a crystal ball, but chances are there'll be a point in the future where rates will go down again and you can refinance.
I also had to look at the overall economic
Yeah.
environment. And there's different segments of the rental market even.
Mhm.
And what I do see is there's really a demand for affordable rentals. If you're going after rentals that are serving that market, it's just really a lot of cities have unmet needs. Now, if you're going to the luxury end, that's a different story. Each segment of the rental market kind of has different dynamics to consider. And as long as you're solving the problem, if interest rates are going, inflation's going, like I think there's still room to play.
I think that's an excellent point. What about having a workflow for raising rents in a way that are consistent with inflation and still maintains a good tenant base that you want to serve in your business? I know you've got also a property management component to your business. In our real estate business, we tend to raise rent when there's a vacancy and then raise them typically in a small amount consistently every time the lease is renewed. And sometimes we'll do a multi-year lease with kind of a step up in rent raises over a 2 or 3 year period if we have a really awesome tenant. Do you also do that or what do you do differently?
I think that's really market specific. What works in Austin is not going to work in suburban Philadelphia. And
Mhm.
the type of tenants that you're attracting. I would say on turnover is the easiest time to do a
And the
rental.
easiest time to do a renovation too.
Yes, yes. It's almost impossible to do a major renovation around the tenant, but
Yeah.
that's typically when I do the biggest adjustments ahead of doing some renovations. Because you have to justify it to the tenant beyond just a general inflation statement. It's kind of like expenses. I guess you're saying inflation, but in different ways. I'm about to do this improvement. Costs have gone up. Good property management or landlording is explaining to the tenant why you have to adjust the rent on an ongoing basis.
Mhm.
There still is kind of a feeling depending on the market, back to what I was saying of, kind of the working class market, how have their wages caught up with affordability in terms of the percent
Mhm.
of their income is devoted to rent. There's limits. You
Yeah.
may want to get this in rent, and you do the little analysis that says the median rent is this, but if your applicant's coming to you consistently or capped at this income, you're also capped. That's
That's a
why I think the neighborhood is really important to think about.
That's an excellent point, and that explains a lot of the differences in the philosophy behind rental returns in an expensive metro area versus rental returns in a suburban Midwestern town, because it's so expensive in, say, the New York City area, for example, that the rental returns as a percentage of the investment tend to be lower. That natural cap on how much you could charge somebody for rent.
More people should think about having a systematic
Mhm.
way of increasing rents because I think that's where some cash flow is left on the table.
Mhm.
A lot of investors are not thinking about adjusting rents over time.
Mhm. Just to compensate for the fact that their costs are going up over time. Their insurance is going up, their water bill is going up, their cost to maintain the property, the replacement costs for appliances and things like that. All of those things go up over time. Having a workflow for yourself where you are consistently doing it over time, you don't have to reach back and try and make a huge rental increase, assuming that's allowed by the local jurisdiction and the local rental laws, is just super helpful. Is there anything we've forgotten to mention today today about cash flow per door and the impact of financing on that cash flow per door.
One other point I did want to make, but we've been talking mostly about the operating
Mhm.
monthly budget, but the budget decision made up front when you purchase the property is important in terms of a lot of people have a vision of how they want, what kind of amenities they want to upgrade. If you're going to put $2,000 a month amenities in an apartment that's only going to rent for 1,000 a month, you're kind of starting in the hole. You're making the cash flow more negative than it should be because you're over improving
Mhm.
the property that the way to a way you'll never recoup your expenses. I had a client who had an environmental background and she really wanted to use more environmentally sound or high end hot water heater. If she did implemented that in this triplex, this was going to blow out the numbers. It made sense to give people living in a certain community access to new things, but she was never going to be able to charge rent to justify that, at least in the next 20 years. It just really didn't make sense. Really, as an investor, when you're looking at that make ready budget, you really do need to figure out how quickly you'll be able to raise rents over time to be able to recoup some of your major outlays at the beginning of the investment.
I think that's an excellent point. And I remember when Steve and I were first investing in rental properties, our property manager, and we still work with the same property manager. She's been an important part of scaling our rental property business and developing this profitable business. Is that I would think that something had to be done or replaced, and she'd be like, "No, we don't need to do that for a couple of years. We're always taking care of safety issues and making sure everything is clean." And I'd be like, "Oh, should we put in wood floors?" And she'd be like, "Oh, we should just replace the carpet or something." That's just an example of something that she might say to try and do exactly that. Don't over improve given who the target person is that's going to be moving in.
I think some of it, a lot of our clients want to be good landlords. They don't want
Mhm.
to be slumlords and they go to extreme, but you just have to be practical for what the demand is at a certain
Mhm.
price point. That's going to keep you more in line or be able to hit those cash flow numbers.
Mhm. If you have a particular niche that you're trying to appeal to, for example, obviously you want to make improvements that are going to appeal to that niche. If you're accepting pets and you take a pet non-refundable pet deposit, for example, maybe you're going to do pergo floors or something like that makes it easier for the pet owner, or a gate into the kitchen door into the backyard or something like that. In general, I completely agree with that. Just to sum up here, talking about in this series about running your numbers, talking about cash flow per door, thinking about the impact of changes in financing costs. How much does this matter? It does matter, but it still means that we have to connect this decision to our goals, as Veronica said, that make ready budget upfront, making sure that it's realistic. Your budget is going to affect your cash flow, and things are going to change with rising rates. We're going to have to reevaluate each property on a deal by deal basis to make sure that it still is going to make sense for those goals and objectives. Any parting words?
I also say appreciation is good.
If you haven't checked out the first in the series, which is episode 11, Does the 1% Rule Still Work? Please go back and give it a listen. And then next in the series, we're going to talk about the role of appreciation. We're going to dive more into appreciation and look at some examples. And then we're going to finish up with what are the other numbers that you need to know in putting your rental property budget together besides rent and expenses? What are the other kind of guidelines that are helpful to use when developing a realistic real estate budget? Veronica, as usual, you are one of my very favorite people to talk to, and I hope to see you next time in the Rental Property Cafe.